Stop what you're doing. Close the charts. Ignore the price on your screen for a moment, because something just happened in the silver market that most people won't understand until it's far too late. This wasn't a rumor. It wasn't speculation. It was a silent move by the smartest players in the room, and it changes everything. Whatever you're doing right now, pause. This is not background noise. This is not another dramatic headline designed to scare you into clicking. What unfolded quietly this morning represents one of the clearest warning signals the silver market has flashed in decades. 4 major global banks, institutions that dominate precious metals trading, abruptly halted silver trading on their desks. No announcement, no press conference, no breaking news banner on financial television, just silence. And silence, in markets like this, is never accidental. If you glance at the silver spot price right now, you'll probably see a number hovering around the low 70s. That number is misleading. It gives the illusion of stability. It suggests order. But while most people were sleeping, scrolling, or going about their routine, a fracture formed beneath the surface of the paper silver market, so severe that some of the largest players simply stepped away from the table. They didn't adjust their positions. They didn't hedge harder. They didn't double down. They walked away. That alone should make you uncomfortable. This wasn't a technical outage. It wasn't scheduled maintenance. These desks didn't shut down because silver looked unattractive. They shut down because continuing to trade would have forced them to confront a risk their internal systems could no longer justify. In other words, the math stopped working, and that's the key point most people will miss. The question is no longer whether silver's price will eventually rise. The real question is whether you'll be holding something real when the paper structure fails, or whether you'll be left with a promise that can't be honored. The blink already happened. The crack is visible now, and the window to understand what this means and how to respond is closing faster than most realize. Let's rewind to earlier this morning. Just after 6 Eastern Time, I was doing what I do every day, reviewing overnight market data, scanning warehouse reports, checking futures positioning, and watching inventory flows. Nothing unusual until one message appeared from a long-standing institutional contact. The message was short, no embellishment. 4 words, silver desk went dark. For anyone unfamiliar with how institutional markets work, let me translate. When a trading desk goes dark, it stops quoting prices. It stops taking orders. It removes itself entirely from the market. Imagine walking into a grocery store at noon and finding the doors locked with no explanation. That's what this looks like inside the financial system. Trading desks are not optional operations for banks. They are revenue engines. Every moment they're inactive is a moment they're not earning spreads, fees, or profits. These institutions exist to intermediate trades. Shutting down a desk, especially during active market hours, is almost unthinkable unless something is very wrong, so I started calling around. Traders, risk managers, operations staff. Piece by piece, a picture emerged, and it was far worse than I initially expected. This wasn't one bank, it was 4. And they didn't suspend all metals trading. Gold remained active. Platinum continued trading. Copper desks stayed open. Only silver was shut down. I can't name the institutions without exposing sources, but understand this, these are not minor players. These are globally significant banks with decades, long histories in the silver market, firms that move billions in volume, firms that help define liquidity itself. And this morning, they all step back at the same time. Eventually, a sanitized explanation will surface. Something boring, something harmless sounding. Systems upgrades, capital reallocation, temporary risk adjustments. Don't buy it. Those explanations are designed for public consumption, not truth. The real story lies inside internal risk meetings and exposure models. And that's where things get uncomfortable. Before we go any further, understand this: what you're about to hear isn't entertainment. It's not hype. It's not clickbait. This is real-time financial intelligence, information that matters precisely because it isn't being talked about openly. Now let's get into why 4 silver desks going dark isn't just notable, it's potentially historic. To understand the gravity of this moment, you need to understand what a major bank's silver desk actually does. Most people imagine banks simply matching buyers and sellers. That's surface-level thinking. The reality is far more layered and far more fragile. At the most basic level, banks facilitate client needs. A mining company wants price certainty. An industrial user wants guaranteed supply. The bank steps in, offering contracts that lock in prices for future delivery. On paper, this looks straightforward. But banks don't want price exposure. They want fees. So they hedge. For every physical or forward commitment they make, they offset risk in the futures market. Long here, short there. Neutral overall. That's the theory. Then comes proprietary trading. This is where desks deploy algorithms, exploit order flow, and make directional bets using insider-level market insight. It's legal. It's profitable. And it works until it doesn't. Finally, banks act as market makers. They provide liquidity. They quote prices. They absorb orders. They keep the market functioning by standing ready on both sides of a trade. All of these functions rely on one assumption: liquidity. Specifically, that physical silver exists in sufficient quantity to backstop the paper claims tied to it. That assumption just failed. Over the past several weeks, registered silver inventory, the metal actually available for delivery, has been draining rapidly. Tens of millions of ounces have disappeared from the system. Meanwhile, the number of outstanding paper claims remains enormous. Hundreds of millions of ounces promised, only a fraction physically present. This imbalance has always existed, but it was manageable when confidence held. Now confidence is cracking. Here's what broke the system. Risk management models are built on probabilities. They assume price moves fall within historical norms. For silver, that meant daily volatility of a few percent. Even extreme scenarios were capped. Losses were painful but survivable. This morning, someone asked a different question. What if silver doesn't move gradually? What if it gaps? What if the paper market freezes while the physical market reprices violently? That's no longer hypothetical. Physical silver in parts of Asia is already trading far above Western paper prices. The divergence is real. The arbitrage bridge is breaking. Run the numbers. A desk short millions of ounces at suppressed paper prices suddenly faces market losses that aren't theoretical, they're existential. And if clients demand delivery, the situation becomes catastrophic. Without sufficient inventory, banks are forced to source metal at any price available. That's how controlled risk turns into uncontrolled loss. Faced with that scenario, risk departments did what they're designed to do. They pulled the plug. And here's the part most people underestimate. Those 4 banks represented a massive portion of silver market liquidity. When they stepped away, a huge chunk of the market vanished instantly. Liquidity isn't linear, it's psychological. When big players leave, others notice. Spreads widen, volatility spikes, confidence evaporates. And once that process starts, it feeds on itself. Meanwhile, the physical market is experiencing the opposite dynamic. Demand is surging. Refineries are operating at full capacity. Mints are backlogged. Retail investors are buying. Industrial users who actually need silver to function are securing supply at almost any cost. They're hoarding. Not for speculation, but survival. This creates a feedback loop. Every ounce removed from circulation tightens supply further. Premiums rise, delivery times stretch, and the gap between paper price and physical reality grows wider. So what happens next? There are only a few paths forward. One possibility is an abrupt repricing. Paper prices leap to meet physical demand. That would mean massive losses for shorts and no intervention. Historically, that doesn't happen. Another option is default. Cash settlement. Force majeure. Paper contracts honored in name only. Physical and paper permanently decouple. This protects institutions and destroys trust. The third path, the one unfolding now, is a managed retreat. Gradual repricing. Controlled volatility. Rules adjusted quietly. Margin requirements raised. Media narratives deployed. Time bought for exits. But even managed retreats end eventually. No matter which path plays out, one outcome remains: constant physical silver wins. Paper claims lose relevance. And the distinction between owning silver and owning a promise becomes everything. So what should you do? First, don't panic. Panic creates bad decisions. The opportunity exists precisely because suppression still lingers. While paper prices remain artificially low, physical metal can still be acquired, though not forever. Second, avoid paper proxies. EDFs, unallocated accounts, and leveraged instruments offer exposure, not ownership. In a delivery failure, exposure settles in cash. Ownership does not. Third, think in terms of insurance, not speculation. Physical silver isn't about quick profits. It's about protection in a system under stress. Timing matters, but precision isn't required. Accumulation over time reduces risk. Focus on reputable sources. Diversify forms. Secure storage discreetly. Most importantly, understand this: what happened this morning wasn't random. It was a signal. Silver is not isolated. It's connected to currencies, debt, and confidence itself. When silver breaks, it's because faith in the broader system is eroding, first quietly, then all at once. We are living through a monetary transition. The rules that govern markets for decades are changing. And silver is where those changes are becoming visible first. The banks saw it. They acted. The question now is whether you will understand the signal or ignore it until silence becomes the only warning left.